Hey guys, we're Group 4 and we are covering Lucent Technologies. Lucent Technologies was a telecom equipment company that made most of its revenue with its three business groups: Network Solutions, Lucent Worldwide Services, and Bell Labs. Lucent Technologies was originally owned by AT&T, and in 1996 it spun off as its own company. In the year 2000, Lucent became the most widely held company in the world, and its share price skyrocketed to over $80 per share.
Now, Lucent had a bit of a shaky start when it first got its IPO. Um, it was AT&T's largest R&D subsidiary, and this is an industry where R&D was being harder and harder to afford and keep care of. So AT&T made the smart move of getting it off, which included moving a lot of its debt onto Lucent. It included, when they broke off, a large amount of debt, which included a $3.9 billion portion of AT&T's debt, which it labeled as its corporate debt. This was a difficult position to be in as a new company. In addition, Lucent was a company that didn't have a great deal of marketing strategy or financial knowledge in its executive board, and they found a difficult time hiring new executives to come in to fill that role. In addition, Lucent made a bold move in investing in CLECs, which stood for Competitive Local Exchange Carriers. Now, Wall Street at the time adored this new technology, and so Lucent heeded to what they said and invested in it. But in reality, this technology had little chance to survive with an already eroding market share of data services. But in the end, Wall Street still continued to praise this unrealistic expectations, and Lucent made bolder and bolder financial deals to keep buying into this technology. In addition to that, the internet industry grew and data traffic switched from voice to internet protocol. Now, a majority of Lucent's inventory was telecom equipment for voice communications, not internet. And as their inventory began to outpace the slowing demand, sales decided to plunge. Executives were then pressured to sell inventory before it became obsolete.
So, with this pressure to sell this inventory, executives started to channel stuff to its customers. So, basically, what it would do is have its customers buy a lot of its inventory, buy a lot of its products, and then make promises to these customers saying that if you don't sell it, we'll take care of it. So, don't worry about it, which they're not allowed to do. It also started creating side deals, so its executives would make sign contracts and agreements with these customers, and then also give them side deals and side bonuses. And then to do this, to give it to their accounting department, they would forge documents to make the deals look real and in full. They also recorded revenue that was not realized or earned. So here's an example of one of the fraudulent sales that they made. They made a $135 million deal with Windstar, but behind closed doors, executives made a $35 million credit for future software purchases and an additional $45 million credit for future network purchases. And then they would send forged documents to its accounting department that didn't have these credits on there. So the accounting department was reporting to the public $135 million as their earned revenue, so to deceive the public. So basic math tells us that the deal that was claimed to be 135 should actually have been about 55 million because Lucent did not take into account the credit liability that it had given on these side deals.
So there are a few red flags that the public should have seen to kind of tell them that the company wasn't performing at the level it should have been. First of all, they had an audit committee full of insiders, and we'll go a little bit more into that on the next slide. The second thing was that it had a past reputation of aggressive accounting practices. This had to do with how they valued their pension assets in the past year, so it should have shown them that they weren't exactly doing these things by the book. They also had increasing accounts receivables while they had decreasing sales and bad debt. So that kind of shows them that they still haven't corrected their accounting principles and practices as much as they should have. And they also had a high turnover of executives, which we'll also kind of touch on in the next slide. Now, their tone at the top was a pretty negative tone at the top because they had a CEO and president of consumer products. They were really driven by self-interest, and they were very demanding when it came to earnings growth. They had a get-rich-or-die-trying kind of attitude, and this kind of went into the whole turnover of executives because if they didn't meet their sales numbers and projections, then they were pretty much kicked out of the door of the company. Now, second thing, coming back to the audit committee, they lacked independence because some people in the audit committee, like Franklin Thomas, were former Lucent directors, and another lady on the audit committee was a co-founder of one of the acquisitions that Lucent had of Ascent Communication. And again, coming back to those high turnovers, they had their executive VPs. They had two of them in a relatively short amount of time because they forced them to retire since they didn't meet their sales projection, and kind of had to get them out the door so they can try to meet those earnings growth expectations that were set by that at the top.
The SEC charged Lucent with fraud in 2004. With the charges were for violating GAAP revenue recognition standards, which came about through Lucent's channel stuffing. And more interestingly, Lucent itself brought the case before the SEC. Lucent was charged with $25 million in fines by the SEC, and 3 executives were charged penalties from in the range of $60,000 to $110,000, and then 2 of the 3 executives were banned from serving on the board or as an officer in any public company. And in 2006, Alcatel, a European company, bought out Lucent in a $13.4 billion stock acquisition.